The world feels like it's spinning out of control. Tariffs, inflation, wars, and your portfolio? Probably just as stressed. So where do you put your money when the world's in chaos? Here's the twist. The answer isn't in tech stocks or crypto. It's in your kitchen. It's in your pantry. It's even in your smoke break. We're talking about consumer staples. Boring? Maybe. But one of them is paying over 10% in dividends, and it's nearly 80% undervalued. In a world where chaos dominates the headlines, consumer staples are quietly winning. In this video, you'll see why now is the perfect time to go all in on stability. We'll break down 3 powerful stocks built to survive storms and thrive in them. Each one delivers steady cash flow, everyday demand, and shockingly high upside, hiding in plain sight. And trust me, one of these? It's paying over 10% in dividends, and most investors have never even heard of it. When markets start trembling, smart investors don't chase the headlines. They head straight for the boring aisle. But in 2025, that aisle isn't just safe, it's undeniably attractive. We're talking about consumer staples, the companies behind everyday essentials, food, soap, cleaning supplies, personal care, the stuff people buy whether they're getting a raise or getting laid off. And right now, with geopolitical tension, tariff threats, and recession warnings flashing, smart money is moving fast towards safety. These businesses don't just survive downturns, they power through them. Steady demand, strong pricing power, and dividends that reward you for staying patient. And the best part? Many of these stocks are trading at fire sale prices, giving you growth, income, and peace of mind in one shot. So we crunched the numbers, dug through financials, and found 3 staples that check every box: strong yield, undervalued price, and recession-proof demand. Let's kick things off with a quiet powerhouse, the company behind your snacks, supplements, and even pharmaceuticals. INGR. This next pick isn't splashed across every dividend video, and that's exactly why it deserves your attention. Meet Ingredion, ticker INGR. It's not a household name like Pepsi or Tide, but it's inside almost everything you eat. Ingredion makes sweeteners, starches, and plant-based ingredients, powering processed foods, beverages, pharmaceuticals, and even industrial products. They serve over 120 countries and supply the companies behind the brands you already know. Without INGR, the food system, literally, slows down. So, what makes this stock special right now? Let's address the risks first. Yes, they're exposed to global supply chains, and yes, the ingredient space is competitive, with heavy hitters like ADM and Cargill always pressuring margins. But here's the twist. Ingredion isn't just surviving, they're managing risk like a pro. They've been cutting costs, boosting efficiency, and outperforming competitors in execution. Now, to the numbers. The dividend yield? 2.36%. Not flashy, but it's rock solid. Backed by free cash flow and a strong balance sheet, this is a payout built to last. The valuation? That's where things get interesting. Ingredion trades at just 12 times forward earnings, while the sector median is over 19 times. That's a 37% discount. For a business with reliable demand and stable growth, it's the definition of undervalued. And that growth? Analysts expect steady revenue gains into 2025, thanks to rising demand for health-conscious and plant-based ingredients. EPS is projected to grow even if the economy flatlines. But here's the clincher. In Q1 2025, INGR improved its liabilities to assets ratio, a key signal of financial strength. In a high-rate world, that means lower risk, better debt control, and stronger returns over time. So what do you really get with INGR? A globally essential company with dependable income, undervalued by over 35%, and positioned to grow in any economy. No hype, no headlines, just consistent performance and long-term upside, powered by the products people use every single day. We've covered food. Now let's talk about a stock that's addictive, literally. This one flies under the radar, but it's delivering steady income and global reach. Let's talk IMPBY. Imperial Brands, ticker IMPBY, is one of the most overlooked dividend payers in the world. Based in the UK, Imperial is a global tobacco company that owns and distributes a wide range of cigarette, cigar, and next-gen nicotine products. While Americans may not see these brands on their shelves, Imperial is massive internationally, operating across Europe, Africa, Asia, and parts of the US. You'll recognize names like Winston, Davidoff, Galoises, and Blue, their vapor brand. Unlike fast-growing tech or biotech firms, Imperial operates in a low-growth, high-predictability sector. And that's the point. This isn't about disruption, it's about stability, consistent cash flow, and shareholder income. Of course, tobacco stocks come with their fair share of baggage. Regulatory scrutiny, ESG concerns, declining cigarette volumes, and competition from players like Philip Morris and British American Tobacco. But Imperial takes a different approach. Instead of chasing risky new markets or overextending into unproven products, they focused on their core strengths, maximizing cash generation from established brands, and returning that value directly to shareholders. And it's working. Imperial currently offers a forward dividend yield of 5.55%, and they've committed to growing it. In fact, they recently restructured their dividend policy to provide more predictable and sustainable payouts, a major plus for income investors. From a valuation perspective, it's trading at a forward PE of just 9.95 times, compared to the sector median of 19 times. That's a 48% discount, and it's not because the fundamentals are weak. Imperial has kept debt levels under control, generates strong free cash flow, and continues to invest strategically in next-generation products. Bottom line, this is a mature, income-generating machine that most US investors are sleeping on. And just when you think we've hit peak defensiveness with tobacco and starches, the next stock takes us somewhere unexpected. It's rooted in protein, price control, and essential consumption, and it might be the most quietly powerful pick of the three. Calm. We're talking about Cal-Maine Foods, ticker symbol CALM, the largest producer and distributor of fresh shell eggs in the United States. Yes, eggs. It might sound niche, but don't let the simplicity fool you. Cal-Maine controls over 20% of the US shell egg market, operating across more than a dozen states with massive production facilities. They supply national grocery chains, food service companies, and wholesalers, putting eggs on shelves and menus all across the country. This is a vertically integrated operation, meaning Cal-Maine owns nearly every step of the supply chain, from feed mills and hatcheries to packaging and delivery. That gives them tight control over cost, quality, and efficiency, something smaller competitors can't replicate. Their product mix spans conventional, cage-free, organic, and specialty eggs, positioning them to serve both value-focused shoppers and health-conscious consumers. And with more states introducing cage-free legislation and major retailers shifting policies, Cal-Maine is already ahead of the curve, expanding capacity to meet that growing demand. Here's the key. Eggs are a low-cost, high-protein staple. People buy them in good times and bad. They're not a luxury item, they're a necessity. That gives Calm one of the most defensive revenue bases in the food sector. Now, like any commodity-based business, they face risk. Egg prices can swing due to feed costs, disease outbreaks like avian flu, and overall supply disruptions. But despite those challenges, Cal-Maine has maintained industry leadership and a debt-free balance sheet, giving it the flexibility to absorb shocks and stay profitable. Their dividend model? Also unique. Calm doesn't pay a fixed dividend, it pays a percentage of net income. That means big payouts in strong quarters and smaller ones in weaker periods. It's sustainable, transparent, and backed by actual earnings. Right now, Calm is yielding a staggering 13.38%, with a forward PE of just 4.3 times. The sector median? 19 times. That's a 77% discount, a rare opportunity in 2025. given the company's cash flow strength and demand tailwinds. Bottom line, this isn't just a quirky play on breakfast. It's a vertically integrated, zero-debt, income-generating machine built on something Americans consume by the billions. If you want yield, real-world demand, and a stock that thrives while others panic, stay calm and collect dividends. So there you have it, 3 consumer staple stocks hiding in plain sight, right inside your house. They don't just survive uncertain times, they thrive. Stay calm, collect dividends, let the chaos work for you. Hungry for more? Tap the video on your screen to unlock more game-changing strategies and take control of your portfolio today.